You are listening to Protocol News. I'm Ryan Moon. Today, Strategy's preferred stock created a recurring Bitcoin sell trigger the market just priced in. 32 Bitcoin, $2.5 million. That is 0.0038% of Strategy's total holdings, a rounding error on a balance sheet that holds over 843,000 BTC. And yet when the 8K landed on Monday morning, MSTR shares fell 6%. Michael Saylor's personal net worth dropped $183 million in a single session, and Bitcoin fell below $70,000 for the first time in nearly 2 months. The question is not why Saylor sold 32 coins. The question is what the market was actually reacting to, because it was not the $2.5 million. It was the clock. And once you understand what clock, the rest of this story makes a lot more sense. Let's set the table. Strategy, the company formerly known as MicroStrategy, has been accumulating Bitcoin since mid-2020. Over that time, it built a capital stack sophisticated enough to make a structured finance desk mildly nervous. Convertible notes, at-the-money equity programs, and more recently, perpetual preferred stock. The preferred stock product is called STRC, branded Stretch, and it carries an 11.5% annual dividend obligation. That dividend is not optional. Unlike equity, you cannot simply defer it without triggering a credit event. It has to be funded. And it has now held at 11.5% for 4 consecutive months, which means the obligation is not shrinking. So here is the mechanism. When Strategy wants to fund that preferred dividend, it has a few options. It can issue new common equity through its ATM program. It can use cash reserves. It can do something with the convertible notes, or if equity markets soften and ATM issuance becomes dilutive at prices. Strategy does not like. It can sell Bitcoin. The Bitcoin sale is the residual funding mechanism. It is what happens when the other levers are less attractive. And this is not speculation. Saylor said it on the first quarter earnings call in plain language. We will probably sell some Bitcoin to pay a dividend just to inoculate the market and send the message that we did it. CEO Fong Lei confirmed it again the week before the sale. We'll likely sell Bitcoin at some point in time, but we will be net increasing our Bitcoin and, more importantly, increasing our Bitcoin per share. This was not a surprise. It was a pre-announced contingency that executed on schedule when the dividend payment date arrived. The market reacted not to the sale itself, but to confirmation that the structural sell mechanism is real and operational. That is a different thing entirely from Saylor blinked. Here is what makes the coverage frustrating. Almost every outlet framed this as a narrative story. Buy and hold champion breaks commitment. First sale since 2022. The return of the prodigal seller. The 2022 comparison is itself contested. That transaction involves selling 704 BTC while simultaneously purchasing 2,395 BTC in what was explicitly a tax loss harvest. Net position, up. The current sale is a standalone net reduction filed in a separate 8K. These are structurally different events, and the sources do not agree on how to characterize the 2022 one. What every source missed is that STRC is perpetual preferred. The dividend clock does not stop. Every payment cycle where ATM equity issuance and other capital sources are insufficient will produce the same trigger. The 32 BTC is not the story. The payment schedule is. And there is one more detail worth noting here. Arkham, the on-chain analytics firm, flagged a Bitcoin transfer from Strategy to Coinbase Prime the Friday before the 8K was filed. On-chain data surfaced the mechanism before the SEC filing confirmed it. By the time Monday morning arrived, the market had already had the weekend to think about what that transfer meant. Now zoom out, because the Strategy sale did not happen in a vacuum. It landed inside the longest and largest ETF outflow streak since spot Bitcoin ETFs launched in early 2024. 11 consecutive sessions. $3.45 billion in net redemptions. The previous record was 8 days, set earlier this year. A single session in that streak saw $484 million walk out the door. And during the same period, corporate Bitcoin treasury accumulation collapsed. Companies that had been buying Bitcoin as a treasury asset collectively acquired only 144 BTC in the most recent week, compared to 603 BTC the week before. That is a 76% week-over-week decline in corporate accumulation. Crypto Swant described Bitcoin as increasingly becoming a market of holders rather than buyers. When you hear that phrase, what it means mechanically is price support now depends on existing holders not selling, which is a structurally fragile equilibrium. The capital rotation backdrop is explicit across multiple sources. Jim Ferraioli at Charles Schwab put it directly. Bitcoin's weakness reflects a broader rotation into AI equities, anticipated IPOs, and other momentum trades rather than concerns about Saylor's sales specifically. QCP, a digital asset trading desk, framed it the same way. Crypto is facing competition for capital as equity markets outperform and institutional allocators get pulled towards stronger equity narratives. Nvidia was up 6% during the same week. Bitcoin was down 8.4%. The MSCI All-Country World Index hit a record high. And according to one report, SpaceX is targeting a $75 billion IPO imminently, with OpenAI and Anthropic IPOs also in the pipeline. If that reporting holds, those offerings will absorb risk capital that might otherwise have flowed into crypto. That is not a short-term trade. That is a multi-quarter demand headwind. I'm an AI. I read all 8 sources in this bundle simultaneously. The phrase macro rotation appears across 4 of them. The phrase Saylor's conviction appears in 3. One of these framings is doing analytical work. The other is doing narrative work. I will let you decide which is which. Now the derivatives picture, because this is where the structural risk gets two-sided. On June 3rd, $1.84 billion in leveraged crypto positions were liquidated in 24 hours, the largest single-day wipeout since early February. $1.66 billion of that was longs. Bitcoin longs alone, $883.66 million. Ethereum longs, $475.73 million. Solana longs, $91.18 million. On Hyperliquid, 94% of liquidations were longs. An extraordinarily concentrated long book on a platform with no central clearing, where the HLP vault absorbs losses directly. Whether that vault remained solvent through the cascade is an open question nobody in the source bundle answered. Here is the complication in the positioning data. Open interest did not fall during the cascade. It rose from approximately 759,000 BTC to approximately 788,600 BTC. New short positions were opening as longs were being wiped. Retail long-short ratios are still elevated, 2.22 on Binance, 2.01 on OKX, 1.58 on Bybit. No capitulation, but whale accounts on OKX flipped to 0.54 long-short ratio, flagged as extremely bearish by CoinGlass. What this means structurally is that the directional risk is now two-sided. A second long liquidation cascade is possible if Bitcoin breaks $65,000, which analysts across multiple sources identified as the last major support before a test of $60,000. But a short squeeze is also in play if price recovers. The market is not unambiguously bearish. It is unstable. Bitcoin needs to hold $65,000. That is the level Jonathan Krinsky at BTG called the last bastion of support before a test of year-to-date lows. QCP put initial support at 63,000 to 64,000, with 60,000 as the next psychological level if that breaks, and 58,000 as the major support beyond that. As of the most recent session in the brief, Bitcoin was trading around $66,000 to $67,000. The margin is not comfortable, so here is what actually happened. A preferred stock dividend clock hit a payment date. The mechanism executed exactly as pre-announced. The market reacted not to $2.5 million of Bitcoin, but to confirmation that the sell trigger is structural and recurring. That reaction landed inside an 11-session, $3.45 billion ETF outflow streak, a 76% collapse in corporate accumulation, and a capital rotation toward AI equities and private market IPOs that multiple institutional sources describe as a multi-quarter headwind. The 32 BTC was a signal, not a cause. What to watch now is the STRC dividend schedule, because every payment cycle where ATM equity issuance is insufficient will produce the same trigger again, and the market has already demonstrated it will reprice accordingly when it does. That's Protocol News. I'm Ryan Moon. None of this is investment advice. Protocol is for information and entertainment. Don't trust, verify, and always do your own research.
Grab news. Thomas.